Hey everyone, welcome. So there's a new investment fund creating a bit of a buzz, and we're going to break it down today. It's the Nifty PSE ETF fund of funds. Now, what does that all mean? Well, at its core, it's a way to invest in some of India's biggest government-backed companies. So let's kick things off with a pretty big question, right? You see all this nation building happening around us, huge infrastructure, defense, energy projects, but how can you, as an everyday investor, actually get a piece of that action? Well, this fund we're talking about, it offers one potential answer to that very question. All right, let's get into it. First things first, that name, Grow Nifty PSE, ETF, FOF. I mean, wow, that is a mouthful, isn't it? But don't worry. The secret to understanding this whole thing is just breaking down that jargon piece by piece. So let's do that right now. Okay, so the first piece of the puzzle is PSE. This stands for Public Sector Enterprise. And really, all that means is a company where the government, either central or state, owns more than half, so over 51%. You can kind of think of these as the heavy lifters, the giants that are building out the country's most critical projects. All right, next up in our name game is ETF. That's an exchange-traded fund. The absolute easiest way to wrap your head around this is to picture a shopping basket. Instead of going down the aisle and picking individual items, or in this case, individual stocks, an ETF lets you buy the entire basket all at once. So here you're buying a pre-made basket of PSC stocks, and you can buy and sell it on the stock exchange just like you would a single share of a company. And that brings us to the last part, FOF, which stands for Fund of Funds. Now, this is a really interesting twist. It's a mutual fund that doesn't buy stocks directly. Instead, it invests in another fund. In our case, it invests in the Grow Nifty PSE ETF. So why do this? Well, here's the kicker. It means you don't need a DMAT account to get in on this. It makes the whole thing a lot more accessible for many people. Okay, so we've decoded the name, we know what it is. But now for the much bigger question, why? What's the whole investment thesis here? Why would you want to focus on these public sector companies in the first place? And a huge part of that why comes down to this one number. You see, government capital expenditure. We're talking about the money being poured into building things like roads, ports, power plants, you name it. That spending has shot up, more than 2.5 times as a percentage of our GDP in just the last 10 years. And guess who's getting the contracts to build all that? You got it, the PSEs. So the whole growth story for these PSCs really stands on 4 main pillars. First, they're right in the middle of this capital expenditure boom we just talked about. Second, these aren't just any companies. They're strategically crucial for the nation. Third, if you look at their books, their fundamentals, like revenues and profits, have been getting stronger. And finally, these guys have the scale and decades of experience to pull off these massive, complex projects. And it's not just random spending either. There are some serious policy tailwinds pushing this forward. It's not just about throwing money at the problem. There's a very clear roadmap. You've probably heard of things like the National Infrastructure Pipeline or PM Gati Shakti. These are massive government initiatives specifically designed to create a solid path for these companies to grow. All right, so we get the why. Now let's pop the hood and see how this thing is actually put together. What exactly are you buying when you invest? And how does the fund work on a day-to-day basis? So it's pretty straightforward, actually. The fund doesn't have a manager picking and choosing stocks. It just tracks an index, specifically the Nifty PSE index. This index is basically a list of 20 of the top public sector companies. What's cool about this is that you're not putting all your eggs in one basket. You're getting instant diversification across really important sectors like power, oil and gas, capital goods, and more. And this brings us to a really crucial point. This is what we call passive investing. There isn't some superstar fund manager making active bets trying to outsmart the market. Nope. The fund just follows the rules of the index, plain and simple. This is great because it takes away any kind of manager bias, and, this is a big one, it usually means you pay lower fees. That fee is called the expense ratio. Okay, we've gone through the what, the why, and the how, but now we get to the most important question of all. Is this fund actually right for you? Let's do a quick self-check. First thing you've got to ask yourself is, are you in it for the long haul? Because all the info about this fund points to one thing. It's built for long-term growth. We're talking 5 years, maybe more. This is definitely not a get in, get out kind of play. And this next one is, well, it's fundamental. Do you actually believe in the growth story of India's public sector? because that's what you're buying into. You're making a bet that these companies are going to succeed and drive the country's growth forward. If that idea gets you excited, then this theme might be a good fit. And finally, let's talk logistics. How do you like to invest? If you're someone who loves simplicity, you like the idea of a low-cost passive fund, and you really don't want the hassle of opening up a demat account, well, then the way this fund of funds is set up is a huge check in the pro column for you. Okay, let's get down to the brass tacks, the actual numbers. The good news is it's super accessible. You can start a SIP with just 100 rupees, and there's no exit load, which is nice. But, and this is really important, I want you to look at that top line. The risk level is officially labeled very high risk. Now, why is that? It's because you're investing in stocks, and you're concentrated in one specific theme. That can lead to more ups and downs compared to a fund that's spread across the entire market. All right, let's zoom out and look at the big picture. We'll wrap this up with the key takeaways, both the good stuff and a few things to keep in mind. So, just to recap the potential advantages here. 1, you get instant diversification across 20 top PSEs. 2, it's a simple, passive fund with clear rules. 3, it's super easy to get into without a demat account. And 4, the minimum investment is tiny, so pretty much anyone can start. Now, for the sake of a balanced view, it's really important to mention this point that came up in an analysis from Alok Wealth. They noted that while the idea behind the fund is strong, some of Grow's other funds haven't been top performers. So that's just something you might want to consider and do a little more research on as part of your homework. And that really brings us back to the core question, the one only you can answer. Could investing in these huge government-backed companies be the thing that helps power your portfolio's growth? Look, this is just a starting point to get you thinking. It is absolutely essential that you read the official fund documents yourself and, maybe have a chat with a financial advisor to figure out if this truly fits into your personal financial picture.